Today we are looking at 5 undervalued REITs that you really need to consider for your portfolio with some strong upside over the next 12 months. As always, we'll look at the historical performance of each of these stocks. We'll dive into their dividend safety. We want to analyze a lot of their financial metrics just to ensure they are incredibly strong for the future. And we will jump into their valuation. We'll get to the intrinsic value, find our acceptable buy price given our investor margin of safety, and see what Wall Street are exactly forecasting in terms of price targets for each one of these 5 REITs. Now make sure you do stick towards the end, as we will be taking a look at a very strong US REIT ETF for those that don't like to pick individual REITs. What I do quite like about this straight off the bat is the expense ratio is very low at 0.08%, but we will take a closer look at this towards the end of today's episode. So let's jump straight into the first undervalued real estate investment trust, that is American Tower Corporation, ticker symbol AMT. Now this over the last 12 months is down -7%. Bear in mind, this doesn't include those dividends reinvested. It is trading in the midpoint of the 52-week range with a P to FFO forward-looking of 18.53, and it does offer a forward-looking yield of 3.41%. Now, over the last 10 years, we can see this stock is up around 136%, but it is a little bit away from all-time highs of August 2021 at $300. So let's take a look at this company. Dividend safety score 78, it does look to be safe. Market cap 89 billion, it is a large cap company. Now in terms of those recessionary metrics, well, last recession they didn't pay a dividend, so we don't have the comparative data. However, recession sales plus 8%, well above the average of the S&P, which was -12, and they also outperformed the S&P -37, with the S&P 500 coming in at -55. Dividend growth, well, the last full year the increases was 10%, which was nice to see, double digits. Last 5 years, 15%, so again, very strong. And the same can be said over the last 10 years, increasing that dividend on average by 19%. And we can see they have been increasing those dividends for the last 11 years. Now, what we quite like to do on this channel is take a look at dividend yield theory. Now, it essentially states a company is undervalued when the current yield sits above the 5-year average. So we have our first sign of undervaluation, 3.47% versus the average of 2.09%. And in actual fact, we have a double sign of undervaluation in today's episode, with the forward P to AFFO ratio coming in at 18.1, lower than the 5-year rolling of 25.4. And in our latest free weekly article, we have gone through undervalued dividend stocks, going through 10 of them, which are undervalued based on dividend yield theory, where we have 2 strong signals. If you want to gain access to these copies, all completely free, click on the pinned comment below to sign up, and you can get instant access. Moving on to the metrics, then we can take a look at the sector P to FFO of real estate. It does sit at 13.7, so we can see American Tower is slightly higher at 18.3. Now, in terms of the payout ratio, typically on the channel, we do focus on free cash flow. For those that are new to the channel, REITs are a lot more volatile, so therefore we do draw your attention to the adjusted FFO, funds from operation, and the majority blanket rule is below 90%. Whilst it has been increasing over the last 10 years, 65% is still very, very low for REITs in general, so no worries on their dividend payout based on this information. We also note over the longer term, their adjusted funds from operation per share is increasing. FY24 expected to be an increase to $10.30, which is a positive sign, and we can see the percentages increases year on year. Last year was -2%, nice to note. FY24 a middle digit at 5%. In terms of sales growth, we want to see for real estate investment trusts 5 to 10% as of steady, moderate growth. We do see it decreasing, although it is very inconsistent. 2023 right at the lower end at 4%, although the last 2 years before that did see strong double-digit growth. And numerically speaking, they have nearly tripled their top line from 4 billion to 11.1. One thing that is incredibly typical with REITs, they will dilute your position as a shareholder, as we can clearly see with American Tower Corporation today, going from 400 to 467. But do know, in fact, this is one of those REITs that doesn't dilute your position at a very quick rate, and do keep an eye on that metric as we do run through the rest of the REITs today in comparison to C. ROIC, return on invested capital, now it is one of my favorite metrics to look at. I personally want to see 10% or more. For REITs, around 3 to 5% to give us that faith that management are able to effectively allocate their capital. And we do see, in fact, well above the 3 to 5%, 6% in the more recent year is a very strong metric for investors, and that is making this company very attractive. Operating margin, a little bit inconsistent, but it is around the mid-30s, 34% in 2023, looking very healthy. And when we look at the final metric for American Tower Corp, a very important one, the earnings before interest, tax, depreciation, amortization. This metric, effectively the net debt to EBITDA, shows us, 1, the balance sheet strength, and 2, the dividend safety. We want to see below 5.5 for REITs, as this signals the number of years it would take the company to pay off all of their debt net of cash on hand. Now, over the more recent period, 5.1 forward is below the 5.5 level, expected to be there or thereabouts in the following year. But one thing to note, it has straddled around that year on year, so do keep an eye on. However, no real red flags that we need to worry about in today's episode. So as always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And as we do deep dives on the channel, we do run through every single one of these models. Today's episode, we're running through 5 undervalued REITs. Let's get straight into the valuation itself. And the intrinsic value is coming at $226. Now, with the current value at $189, we do want to start off with a 10% margin of safety. Remember, we execute on that if we believe it meets the 3 criteria. It has to have a wide moat, strong financial metrics, and good forward-looking data. And then we go till it's near the current trading price. It doesn't offer a 20% MOS level just yet. It does have at least a 15%, so in between a 15 to 20% for AMT in today's episode. In terms of Wall Street and their forecast, well, they see some very strong upside, a price target of $233, and they see upside of 23% over the next year. As always, though, do let us know your thoughts in the comments below if you are adding to any of these REITs or purely adding them onto the watch list. Now, before we do get onto the next undervalued REIT, just to let you know, we do have a 20% off discount if you do want to sign up to Seeking Alpha. What is quite good as well is you do also get a 7-day free trial for any new subscribers. If you are interested, do click on that pinned comment below, and you can also start to analyze stocks similar to how we do today. The next undervalued REIT that we are analysing, it is Crown Castle, CCI. Now, this is down 25% over the last 12 months. Over the last 10 years, up 36%. We can see it has been downtrending ever since all-time highs of around $209 and currently does trade towards the mid to lower end of the 52-week range, with this very nice yield, in fact, starting at 6.21% and a P to FFO of 14.66. Now, in terms of the dividend safety, we have a score here of 60. It is borderline safe. Market cap, $44 billion. It is a large cap company. Now, last recession, again, similar to AMT, they didn't pay a dividend. However, they did have positive recession sales, although they did have a near recession return at negative 57. Now, they haven't had an increase since October 22, but on average, over the last 5 years, it has gone up by around 8%, and we can see they have been increasing those dividends over the last 9 years. Now, in terms of looking at dividend yield theory, we do have that strong double undervaluation signal, 6.22% above the 5-year average. Forward P/FO significantly lower than the 5-year rolling of 23, coming in at 14.5, and it is slightly higher than real estate sector at 13.7. In terms of the adjusted funds from operation payout, now it has been below 90% over the last 10 years. Do bear in mind though, 2024 it is expected to be around that 90% level. So one thing that I would say just to keep an eye on, and when they do release their next annual report, we will cover that on this channel. Adjusted funds from operation, well, it has increased over the longer term to 755, but we can see a drop expected into 2024, which does make us understand why the share price has been hit hard over the last 12 months. Adjusted funds from operation, not too bad. In fact, some years of very, very strong growth at double digits, some years of fairly standard, although we do want to point out 2024, they are expecting this to be slightly lower. And we can see sales growth while we want that 5 to 10% target, and they've hit that nearly every single year. Last year's full report did come flat in previous year's comparison. In terms of shares outstanding, similar to AMT, they don't dilute your position at a very rapid rate, similar to other REITs that we have reviewed, like Vici Properties, Realty Income. And for those that do want to see the numbers, they have pretty much doubled their top line over the last 10 years. Now, in terms of ROIC, nice to note it is upward trending. 7% over the last 2 years is very strong as well. So this company, CCI, Crown Castle, is very strong with regards to this metric, just like AMT. Operating margin, we have some operating efficiencies. It has increased over the last 10 years, so that is positive to note. 2023, their best year in relation to this margin, so it is good to see that they are improving over the longer term. And again, similar to AMT, they do straddle around that net debt to EBITDA target of 5.5. It is below that in 2023, but expected to be slightly higher in 2024. So a few things just to take account of when we do get their next annual report, and to take in detail when we analyze management's forward guidance and their quarterly earnings. In terms of the valuation, don't forget you can grab a copy of this model by clicking on the pinned comment below, where you can run companies of your own or in your own portfolio by clicking on that and putting them through based on your own estimates and judgments. So margin of safety at 10%, a buy up to 119.83, at 20%, a buy up to 106, and at 25%, pretty much there, a few cents shy. So CCI, we do believe, has a very large MOS level. In terms of Wall Street, well, they see some very nice upside as well. They do believe this, similar to AMT, to be a very strong buy now. Price target $123, upside 23%. And remember, this is over the next 12 months. The next undervalued dividend REIT that we have is EPRT, Essential Properties Realty Trust. Now, this is up 6% over the last 12 months, and we can see over the last 5 years, in fact, up 34%. It is trading in the upper end of the 52-week range, but we do see, in fact, Seeking Alpha analysts, Wall Street analysts, and quant analysts all giving this a buy, in fact, with the latter two giving them a strong buy now. In terms of yield, 4.5%, and the P to FFO of 13.6. Now, in terms of dividend safety, a score of 60, borderline safe. We can take a look at some of those metrics. Market cap, 4.6 billion, a mid-cap company. Now, the key metrics, we don't actually have any of that data, given this was one that was founded after. Dividend growth, well, last full year at 4%. However, over the last 5 years, it has increased by 21% year on year on average, which is very strong, with 5 years of consecutive increases. Now, in terms of dividend yield theory, what we can see here is reasonable valuation, with the yield coming in pretty much bang in line with the 5-year average. However, the forward P to FFO is lower than the 5-year rolling of 16.1 and a little bit higher than real estate's sector average. In terms of the dividend, or in fact payout ratio, we do see below 90% every single year. 66% in 2024 also looks very healthy for this REIT. In terms of adjusted funds from operation, it does increase for the large part most years. 2024 also expected to be an increase, which is nice to know. In fact, around 5% expected in terms of percentages. Sales growth, very strong. Whilst it did have triple-digit growth in 2017 and has started to come down, last 2 years in the mid-20s is still very strong for this real estate investment trust. And we can see, in fact, it has more than 10 times over the last 10 years. Now, one thing we want to note, and one thing we did point out earlier in terms of their shares outstanding, they would have diluted your position at a very rapid rate over the last few years, as we can see, at a much quicker rate than AMT and CCI. But again, it doesn't necessarily mean they're uninvestable, just something to consider, especially when you're looking at your investment thesis and even in your margin of safety. Positive to note, the ROIC has been increasing over the longer term, 4% in 21-22 and 5% is looking very nice and attractive in 2023. In terms of the operating margin, not also is it very high in 2023 at 62%, but it has been increasing very rapidly over the period, showing that that operational efficiency is working very, very well with management and this company. In terms of the net debt to EBITDA, below 5.5 from 2022 and going down very rapidly. 4.12 expected in the full year accounts of 2024 is very strong, and that will really help with that dividend safety score as well that we did note above. Now, in terms of the analysis, remember, just because a company is very strong, it is one you want to add to your portfolio. Doesn't mean you should hit that buy button. You should always look at your margin of safety and ensure there is some room there. So our intrinsic value arrives at $30.16 today. When we use a 10% MOS level, it is a buy up to $27. 20% we can see is not quite there yet. So we see in today's episode pretty much 1 cent shy from being a 15% MOS based on the estimates and judgments we have used. Now, in terms of Wall Street, they believe there to be some nice upside of around 14%. They do have a price target of $29, and as we covered not too long ago, Wall Street do believe this is a very strong buy now. We then move on to Kimco Realty Corporation, which over the last year is in fact down 2%. When we do take a look over the last 5 years, it is nearly flat. It is up just 2%. I guess if you do include dividends reinvested, it would be slightly better. We do note, however, it is in the mid to lower end of the 52-week range with a yield of over 5% and a P to FFO of just under 12. Now, in terms of the dividend safety, we have a safe score of 70, market cap $12.5 billion. It is a large cap company. Now, in terms of the key metrics, well, they did in fact cut the dividend during the last recession. They had above average growth, although it was pretty much flat, but they did significantly trail the S&P. In terms of dividend growth, well, the latest increase was October, around 4.3%, pretty much in line with the inflation increase that we try to advocate on the channel, although we do know they did recently have a dividend cut, hence why we do see these drops in 2008 as well as 2019. However, they do have 3 years now of consecutive increases. In terms of dividend yield theory, well, what we can see here is a sign of undervaluation. The yield is over 5, with the rolling being 4.39. And we also note the sector P to AFFO of 13.7 is lower than the forward P to AFFO of Kimco at 15.4. So when we take a look at the adjusted funds from operation, it is below 90% consistently. 79 expected in 2024, and was what it was reported in 2023 was looking very healthy. In terms of the adjusted funds from operation per share, it is very inconsistent over the last 10 years. Something to note, however, 2024 they are expecting an increase to $1.22. And again, it is very inconsistent, so we will factor this into our margin of safety. 2023, they did have a drop of 2% to that adjusted FFO per share growth, although the next year is expected to increase. And we can, in fact, see when looking at their sales growth, some strong double-digit growth in 21 to 22, although this did come down in 2023. And when we look at it over the longer term, they have increased their top line by 80%, coming to $1.8 billion in the more recent year. They have also diluted your position. Again, no surprises there, but we can see not at a very rapid rate over the course of the last 10 years. ROIC between that 3 to 5% that we do target, 3% in fact consistently over the last 4 years. Ideally, we don't want to see it drop below that, so maybe keep that in mind. And we do note the operating margin pretty consistently around the mid-30s year on year. Finally, with Kimco Realty's net debt to EBITDA, we do see it very high at 6.29 in 2023, although we do believe FY24 will be a much better year for them, as we do see this expected to drop very rapidly by 1 point down to 5.29. Now, in terms of the valuation, let's take a look at it, as it is very important to factor in a lot of this in terms of the margin of safety that we did discuss earlier. At a 10% MOS level, a buy up to $20.26. At 20%, we can see it isn't quite there yet, not too far, but we see between a 15 to 20% MOS for KIM in today's episode. In terms of the upside, well, we can see here Wall Street are forecasting $22.54. They do believe this to be a strong buy with 20% over the next 12 months, looking very strong when you are locking in a very nice starting yield. We then move on to one of the REITs with the highest upsides today. It is Big Yellow Group. Now, this is down 7% over the last 12 months. It is a self-storage REIT. Over the last 10 years, we do see it up 48%. It has fallen significantly from the beginning of 2022, where it was at $23. Currently trades in the mid to lower end of the 52-week range with a yield of over 4% and a PE sitting at just around 10.5. Terms of looking at this, well, this is a UK company, therefore we don't have the majority of the data that we do with the other REITs, but we can see the last full year, 8% increase to the dividend, last 5 years, again 8%, and over the last 20 years, a double digit at 21%, making it a very fast growing REIT, although we do note they did cut their dividend in 2008, but since then it is looking a lot better. In terms of taking a look at the essential earnings payout and the free cash flow payout, We can see here that it is below that 90%. In fact, in the more recent year at 79%, is looking very healthy. Remember, for REITs, we don't really want to see it go below or in fact above that 90% level. They have been increasing the earnings per share year on year for the large part, in fact, more than doubling it over the course of the last 10 years. Very minimal movement, however, expected in 2024. In terms of their sales growth, remember 5 to 10%. They do struggle to get that year on year, but we do at least note they are increasing their top line continually. And unlike some of the REITs we have reviewed today that have had some years of negative growth, they are increasing year on year. In fact, more than doubling their top line over the last 10 years. And as well, it is quite nice to show REITs that don't dilute your position very quickly. And in all honesty, the majority of REITs we have reviewed today have really diluted your position in a very rapid rate, like we would advise other companies have. So you can take a look at those other reviews. ROIC as well, around the 4 to 5% level consistently, which is very strong, very healthy. And we can note their operating margin has increased over the last 10 years. So again, it is nice to know operational efficiencies with companies. Not only do companies increase their revenue, which we like to see year on year, but when they also increase their margins, that is a very strong sign of a company. Net debt to EBITDA, then, they have brought this significantly lower, below that 5.5 that we want to see. In fact, only in 2014 and 2015 was it higher. 4.08 in 2023, expected to go below 4 in 2024. So that is a very strong sign of a good REIT, and it is very important to understand that when looking at your analysis. In terms of the valuation, and don't forget you can grab a copy of the valuation model by clicking on that pinned comment below, so you can get your own intrinsic value for companies in your own portfolio and in your watch list. At 10%, it is a buy up to $14.32. At 20%, it isn't quite there yet, but we aren't that far off. So we would say in today's episode of Big Yellow, this is essentially giving us a 15 to 20% MOS, but really it is right there at that 20% level. In terms of Wall Street and their exact target, well, they expect this to have upside of 33%, and they have a price target of $17.24. So this is one that they do believe is a very strong buy. In fact, out of all 5 that we have reviewed today, this is one that maybe you should take a closer look at, do your own due diligence, as not only do the metrics look very healthy, but the upside does look to be there as well. As I mentioned earlier, for those that don't like to particularly buy REITs individually, whether it's just buying them or buying a group, there is also the alternative of iShares Core US REIT ETF. Now, this is essentially a low-cost access to a diversified group of US REITs, and it is definitely low cost. I mean, an expense ratio of 0.08% is very, very good. When you do take a look at ETFs, if there are any that you hold or you're interested in, always look at that expense ratio. This is probably going to be one of the lowest that you will be able to find, and it is one that if you are an income investor, it is good, and you also get that element of growth. Now, in terms of taking a look at their holdings, we can see here now their top 10 holdings. The majority of their weight does go to Prologis at 11%, but they hold a lot of high-quality REITs. Equinix is one that we have reviewed on the channel. It does have a very, very strong background in terms of their metrics. It is looking like one that I personally would say should be in every REIT investor's portfolio. And then you have some others, Welltower, Simon Property Group, PSA, Realty Income, a lot that we have reviewed on the channel. But remember, it really comes down to what you are as an investor. If you like to buy undervalued REITs or even undervalued dividend stocks, or if you like to buy ETFs as a whole. As always, though, do let me know your thoughts in the comments below. My personal opinion is I do like to hold a portion of the portfolio in ETFs, but also execute on dividend stocks or REIT stocks when they become very undervalued and there is a lot of value to be gained there. However, I am interested to hear your thoughts. Do you hold a lot of your portfolio in ETFs? Maybe you hold just a little bit, but the majority in picking stocks. Let me know, and let me know your thoughts on today's episode, whether or not you're adding to any of these undervalued REITs in your portfolio, or maybe you're just placing them on the watch list. Don't forget as well, if you do want to sign up to Seeking Alpha, which we did run through earlier, you can get 20% off, and you get a free 7-day trial. As always, see you all in the next one. Don't forget to hit that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And for now, take care.